Hello everyone and welcome back to our channel. Today we have an important topic to discuss, financial literacy. This video is all about helping you build a strong financial foundation for future success. So, whether you're a recent graduate, in your early career, or just someone looking to improve their financial knowledge, this video is for you. 1. Why financial literacy matters. Before we dive into the specifics, let's talk about why financial literacy is crucial for young adults. The reality is that many young people face financial challenges, like student loans, credit card debt, and living paycheck to paycheck. These financial struggles can lead to stress, strained relationships, and hindered career progression. But the good news is that by mastering financial literacy, you can take control of your financial future. 2. Budgeting and financial planning. The first step in building a strong financial foundation is creating a budget. A budget helps you track your income and expenses, allowing you to make informed financial decisions. Track your expenses. Gather your financial data, collect all your financial statements, including bank statements, credit card statements, and receipts. Categorize expenses. Divide your expenses into categories like housing, transportation, groceries, entertainment, and savings. Use a budgeting tool. Consider using budgeting apps or spreadsheets to make tracking easier. Input all your expenses into the tool. Set financial goals. Identify your goals, determine your short-term and long-term financial objectives. These could include paying off debt, saving for a vacation, or building an emergency fund. Assign dollar amounts. Attach specific dollar amounts and timelines to each goal. Prioritize your spending. Differentiate needs versus wants. Clearly distinguish between essential expenses, needs, and discretionary spending, wants. Allocate funds. Allocate your income to cover your needs first. Ensure you're paying bills, saving, and addressing high-priority goals before spending on wants. Review and adjust. Regularly review your budget to see if you're staying on track. Adjust your spending as necessary to meet your financial goals. 3. Saving and investing. Saving and investing are essential components of financial literacy. They help you build wealth and achieve your long-term financial goals. Let's explore how to save effectively and start investing wisely. Savings accounts. Definition: savings accounts are secure, interest-bearing accounts offered by banks. They provide a safe place to store your money while earning some interest. Use savings accounts for short-term goals, emergency funds, or as a place to hold money before investing. Emergency funds. An emergency fund is a savings reserve set aside for unexpected expenses, such as medical bills, car repairs, or job loss. Recommended amount: aim for 3 to 6 months' worth of living expenses in your emergency fund to provide a financial safety net. Investment options. Stocks represent ownership in a company. They have the potential for high returns but come with higher risk due to market volatility. Bonds. These are debt securities issued by governments or corporations. Bonds offer more stability and regular interest payments compared to stocks. Retirement accounts. Examples include 401(k)s and IRAs. They offer tax advantages and are designed to help you save for retirement. Tips for beginner investors. Start with education. Learn the basics of investing, such as asset classes, stocks, bonds, etc., risk tolerance, and diversification. Set clear goals. Define your investment goals. Are you saving for retirement, a home, or a vacation? Your goals will influence your investment strategy. Build a diversified portfolio. Don't put all your money into one investment. Diversify your portfolio across different asset classes to spread risk. Consider low-cost index funds. For beginners, index funds or exchange-traded funds, ETFs, can be an excellent choice due to their diversity and low fees. Automate your investments. Set up automatic contributions to your retirement accounts or investment accounts to ensure consistent savings. Stay informed. Keep up with financial news and market trends, but avoid making impulsive decisions based on short-term fluctuations. Consult a financial advisor. If you're unsure about where to start or need personalized advice, consider working with a financial advisor. 4. Managing debt. Dealing with debt is a common challenge for many young adults. In this section, we'll discuss strategies for managing and reducing your debt effectively, whether it's student loans, credit card debt, or other obligations. Importance of good credit. Loan approval. Lenders use your credit score to assess your creditworthiness. A good credit score increases your chances of getting approved for loans, such as mortgages, car loans, and personal loans. Interest rates. A higher credit score often leads to lower interest rates on loans. This means you'll pay less in interest over the life of a loan, potentially saving you thousands of dollars. Rental approval. Landlords may check your credit history when deciding to rent an apartment. Good credit can make it easier to secure housing. Utility services. Some utility companies may review your credit when setting up accounts. A strong credit history can make it simpler to establish utility services. Insurance rates. Insurance companies may consider your credit score when determining insurance rates. Good credit can lead to lower premiums. Building a strong credit history. Pay bills on time. Consistently paying bills, including credit cards, loans, and utility bills, on time is the most critical factor in building good credit. Keep credit utilization low. Try to use only a small portion of your available credit. High credit card balances relative to your credit limit can negatively impact your score. Maintain a mix of credit. Having a mix of different types of credit accounts, such as credit cards, installment loans, and a mortgage, can positively influence your credit. Avoid opening too many accounts. Opening too many new credit accounts in a short period can lower your score. Be cautious about opening new accounts unless necessary. Regularly review your credit report. Obtain free copies of your credit report from the major credit bureaus, Equifax, Experian, TransUnion, annually and review them for errors. Establish credit history early. If you're new to credit, consider starting with a secured credit card or becoming an authorized user on a family member's account to establish a positive credit history. 5. Financial goals and long-term planning. To secure your financial future, you need to set clear financial goals. Whether it's buying a home, starting a business, or retiring comfortably, we'll explore how to set and achieve these goals through careful planning. Retirement planning and compound interest. Retirement planning. Retirement planning involves saving and investing money during your working years to ensure you have enough funds to support your lifestyle after retirement. Power of compound interest. Compound interest allows your investments to grow exponentially over time. It's the interest earned on both your initial investment and the interest that accrues over time. Starting early matters. The earlier you start saving for retirement, the more time your investments have to benefit from compound interest. Even small contributions can grow substantially over decades. Example, consider two individuals who both save $100 per month for retirement. One starts at age 25, and the other starts at age 35. By age 65, the person who started at 25 will have significantly more savings due to the longer time for compound interest to work. Maximizing retirement savings. To maximize your retirement savings, contribute regularly to retirement accounts like 401ks and IRAs, take advantage of employer matching contributions, and invest in a diversified portfolio tailored to your risk tolerance and goals. Seek professional advice, consult with a financial advisor or use retirement calculators to determine how much you need to save for a comfortable retirement and develop a strategy to achieve your retirement goals. 6. Protecting your financial future. To complete your financial foundation, you need to protect your assets and loved ones. We'll talk about various types of insurance, estate planning, and how to ensure your financial future is secure. Remember that financial literacy is an ongoing journey. Economic conditions change, and so should your financial strategy. Stay informed and adaptable to ensure long-term success. Thank you for joining me on this journey to understand and implement financial literacy for young adults. Building a strong financial foundation takes time and effort, but the rewards are immeasurable. By following the steps we've discussed today, you're well on your way to financial success. I'd love to hear your thoughts and experiences with financial literacy in the comments section below. Don't forget to like this video and subscribe to our channel for more valuable content on personal finance and self-improvement. Remember, you have the power to shape your financial future. Stay curious, stay informed, and stay financially literate. Until next time, take care.